Right now, while you're watching this video, someone your exact age, same income, same starting point, just quietly crossed $100,000 in their investment portfolio. They didn't win the lottery. They didn't get an inheritance. They didn't have some secret Wall Street connection. They just started earlier than everyone else. And here's the uncomfortable truth that nobody in your life is telling you: every single day you wait to invest is a day you are literally paying to stay broke. Stay with me, because by the end of this video, you're going to understand money in a way that most 40-year-olds still don't. And I'm going to show you exactly where to begin. Let's be real about the world you're navigating right now. You're dealing with student debt that feels like a boulder on your chest. Rent is eating 40% of your paycheck. Everything costs more than it did 2 years ago. And somehow your parents' generation is telling you to just save more, right? On what exactly? The $3.50 left after Spotify rent and that one DoorDash order you swore was going to be the last one. Look, I'm not here to shame you about your spending. I'm here to tell you that saving alone will never build wealth. In fact, if you've got money sitting in a regular savings account right now, inflation is quietly eroding its value every single month. The system was not designed to make you wealthy. It was designed to keep your money moving through you, into the pockets of the people who figured out investing decades ago. But here's what changes everything. The single most powerful financial tool available to any 25-year-old right now costs absolutely nothing to start. I'll reveal exactly what it is, but first you need to understand why most people never use it. Here's the shift that separates the people who build wealth from the people who just talk about it. Most people think about money as something you spend. You earn it, you spend it, maybe you save a little. Repeat until retirement if you even get there. Wealthy people think about money as something you deploy. You earn it, you put it to work, and then you let it generate more money while you sleep. That's not a metaphor. That is literally how compound interest works. And it is the closest thing to a financial superpower that exists on this planet. I know. You've heard the word investing and immediately pictured some guy in suspenders screaming at a ticker tape. That is not what this is. This is about you right now in your 20s, making a decision that your 50-year-old self will either be incredibly grateful for or devastated you didn't make. So let's get into the how. Investing at its core is simple. You put money into something that has the potential to grow in value over time. That something can be stocks, tiny ownership slices of real companies like Apple, Amazon, or Google, bonds, essentially loans you give to governments or corporations in exchange for interest payments, index funds and ETFs, baskets of hundreds of stocks bundled together. So you're not betting on one company, you're betting on the entire market. And here's where it gets exciting. The S&P 500, an index of America's 500 largest companies, has returned an average of about 10% per year over the last century. Every crash, every recession, every global crisis. The long-term average is still around 10%. That means $1,000 invested today could be worth over $17,000 in 30 years without you doing a single thing after that initial investment. Let that land. But the type of account you put that money into matters just as much as where you invest it. Get this wrong and you could be handing a massive chunk of your gains straight to the IRS. Coming up, the accounts that legally protect your money from taxes. Before you buy a single share of anything, you need to understand where you invest, because the container matters as much as what's inside it. The 401k, if your employer offers one, especially with a match, this is free money and it needs to be your first stop. Contribute at least enough to get the full match. Not doing so is the financial equivalent of leaving cash on the table and walking away. The Roth IRA. This is the hidden gem most young people don't know about. You contribute money that's already been taxed and then it grows completely tax-free. When you retire and pull that money out, zero taxes. On potentially hundreds of thousands of dollars in growth. For this year, you can contribute up to $7,000 per year to a Roth IRA. That's less than $600 a month. And the earlier you start, the more devastatingly powerful it becomes. Taxable brokerage account. Once you've maxed out your tax-advantaged accounts, this is your overflow. More flexibility, but you'll owe capital gains tax on profits. Now I want you to pause for a second and honestly ask yourself, how many of your friends know any of this? How many people in your social circle are talking about Roth IRAs and index funds? Probably not many. And that gap in knowledge, that is the wealth gap. All right, you've got your account. Now what do you actually buy? Here's the beginner framework that even most financial advisors use as a baseline. Start with broad index funds. Specifically, a total U.S. market index fund or an S&P 500 index fund. Ticker symbols to look up: VOO, VTI, FXAIX. These are not hot tips. These are the most recommended, battle-tested starting points for long-term investors. Why? Because instead of trying to pick winning individual stocks, which even professional fund managers fail to do consistently, you're buying everything. You're saying, I believe in the long-term growth of the American economy. And historically, that has been a very safe bet. The rule of thumb for your 20s, a simple and effective starting allocation is 90% stocks, 10% bonds. You have time on your side, which means you can afford to ride out market volatility. As you get older, you gradually shift toward more bonds for stability. How much do you need to start? Some index funds let you start with as little as $1. Apps like Fidelity and Vanguard allow fractional shares. You do not need to be rich to begin investing. You need to begin investing to eventually be rich. But here's the mistake that stops most beginners cold, even after they open the account and buy the fund. It's not about what you buy, it's about what you do next. And 90% of people get this completely wrong. I'll show you what it is right after this. Here it is. The mistake that costs beginners more money than any bad stock pick ever could. They watch the market, and then they panic. Markets drop, they always have, they always will. Corrections of 10 to 20% happen roughly every 1 to 2 years. Bear markets, drops of 20% or more, happen every several years. The average investor, when they see their portfolio drop by 15%, does the worst possible thing. They sell, they lock in the loss, they miss the recovery, and they prove once again that emotions are the enemy of wealth. The data is brutal here. A study found that the average investor earned significantly less than the market itself, not because they picked bad investments, but because they kept interfering with their own portfolio. The strategy: dollar cost averaging. Invest a fixed amount on a regular schedule, weekly, bi-weekly, monthly, no matter what the market is doing. When prices are high, you buy less. When prices are down, your money buys more at a discount. You stop thinking about it. You stop checking it every day. Your investment account is not your Instagram. You don't need to check it every hour. It doesn't get lonely, I promise. Set it, automate it, leave it alone. That discipline, more than any hot stock tip, is what builds generational wealth. I want you to imagine something. It's 20 years from now. You're in your mid-40s. You wake up without an alarm, not because you retired early necessarily, but because you have choices. Because the money you started investing in your 20s has been silently, steadily compounding in the background of your entire life. You have the option to take a year off, to switch careers without financial panic, to help your parents if they need it, to invest in your own business, to travel, to live on your terms. That is what this is really about. Not stock tickers, not charts, not financial jargon. Freedom, the kind of freedom that comes from making one decision, the right decision at the right time. And that time is not someday. It is not when you're more stable or making more money. The most powerful investing you will ever do is the investing you do right now in your 20s, when time is your greatest asset. Every year you delay starting, you are not just losing money. You are losing time, and time is the one thing money cannot buy back. Let me show you this one final number, and I need you to really feel this. If you invest just $200 a month starting at age 22, at an average 10% annual return, by age 62 you'll have approximately $1.27 million. If you wait until age 32, just 10 years later, same $200 a month, same return, you'll end up with about $452,000. Same money, same return. 1 decade of delay, $820,000 gone. Simply because you waited. That is not a cautionary tale. That is a gift, because you are watching this now, which means you still have time to be on the right side of that equation. The question isn't whether you can afford to invest. It's whether you can afford not to. Here's your action plan. 3 steps. Do them this week. 1. Open a Roth IRA with Fidelity, Vanguard, or Schwab. It's free. It takes 10 minutes. 2. Set up a recurring deposit, even $50 or $100 a month to start. Automate it so you never have to think about it. 3. Invest those contributions into a broad index fund like VOO or VTI. That's it. That's the whole strategy. You don't need to be an expert. You don't need to predict the market. You just need to start. The wealthy people of the next generation are being decided right now, not by luck, not by birth, but by who decided to take action while everyone else was waiting for the right time. Be the person who started. Now, if what I just shared clicked for you, if you felt that moment where everything started to make sense, you need to watch the next video on this channel immediately, because we just covered how to invest. But the video coming up on your screen right now, it reveals why your money grows so explosively over time, a force so powerful that Einstein reportedly called it the 8th wonder of the world. It's called the power of compounding. And once you truly understand it, the way you think about every dollar you earn will never be the same. Click it now, because that video is where everything we talked about today becomes something you can feel in your bones.